Assalamualaikum warahmatullahi wabarakatuh. Alhamdulillahilladzi hadana li hada wa ma kunna linahtadiya laula an hadanallah. Asyhadu an la ilaha illallah wa asyhadu anna Muhammadan abduhu wa rasuluh. Allahumma shalli ala Muhammad wa ala alihi wa ashabihi wa man tabi'ahu bi ihsan ila yaumiddin, amma ba'du. Hello student, our lecture today is financial management. We want to discuss about the financial management. We start here. A good place to start is about the question, what is the finance? What is the finance? The finance is the complex. Finance is the economic, statistic, and accounting. That is the finance. The combination of the economic, statistic, and accounting. Another people say that the finance is the science of capital. Finance is science of capital. In other words, it considers the allocation of money across investment opportunities. Allocation our money to the investment opportunities that we have. And then necessary to draw on this underlying discipline in make such decision. The decision. And we will concentrate on corporate finance rather than the personal finance. Okay, in this lecture we focus on the corporate finance, industrial finance, corporate finance, not personal finance. So when we're talking about the investment is the corporate investment. And fundamentally, their concept is parallel. You can see almost the same. Corporate finance and personal finance. We have the typical question here. For example, 3 years ago, your cousin Ralph opened a brew pub in downtown Boulder. Your cousin Ralph opened a brew pub, opened a business. Okay. Well, in 3 years ago, your cousin opened a business. Well, it has been operating fairly successful. You can see his business is successful, and its survival depends upon some expansion and upgrade in its production equipment, and he want to expansion and upgrade in its production equipment. Okay. Ralph has come to you as a potential equity investor, and then they propose or they offer to you that he requires $100,000, and the two of you are discussing the ownership stake he would imply for you. So this is the money that he required to expansion his business and to upgrade. He need $100,000 and offer to you, and then he will give you the ownership of this business. He will offer to you to have the ownership of the business. Ralph argues that 3 years ago he invested $30,000 of his own capital, and he also accrued that for 3 years he has been working at less than competitive wage in order to reinvest the generated cash. He argued to you that in 3 years he has been reinvest the generated cash or his profit. The investment is profit. He estimate this amount $40,000 in seed equity for each of 3 years. So we can say in 3 years is 40,000 times by 3 equal to $120,000. Ralph suggests this fact imply your $100,000 will purchase 40% of the equity of this business. So this is the own capital of the Ralph, and then this is the profit that reinvest in the business, and he calculate that he got 30,000 plus 40,000 every years, or times 3 to the summation is $150,000. Ralph claimed that they have $150,000, and your $100,000 will purchase 40% of the equity of the business. 100 and 150, 250. So your equity is 100 divided by 200. 100%, and you got 40% of the equity. The big question is this argument valid? Is this argument valid that 100,000 your money will purchase 40% of the business? This is valid? This argument is valid? Okay, this is our topic in this lecture. We will to investigate that the Ralph argument is valid. So we want to know to evaluate a business. How we evaluate the business, or we do the valuation. How we can the valuation of the Ralph business? In Bahasa, we can say that the valuation, we make a valuation of the business. Valuation of the business. In basic, we know that the asset have value due to the payoff they generate for those that purchase them. What does past investment have to do with this? The price you should be willing to pay for an asset depends upon the future value you will receive. Depends upon the future value you will receive from owning that asset. The price you should be willing to pay. Another piece of the puzzle is that cash today is more valuable than cash tomorrow. Is more valuable than cash tomorrow. Or we can say that is time value of money. That the cash today is more valuable than cash tomorrow. $1,000 in 2020 greater than 1,000 in 2021. That is mean of the time value of money. Most business decisions come down to an evaluation of money today versus money tomorrow. Yes, the time value of money. Come from here, time value of money. Every business evaluate, and most business decisions come from the money, from evaluation of the money today versus the money tomorrow. That is the basic of valuation. Okay, valuation basic of the business. Talking about valuation, the present value formula is a way to express today's value. The present value formula is way to express today's value of a stream cash payment to be received in future. Present value formula. Suppose you expect to receive cash payment, 100, 150, 180, and 210 respectively at year end for the next 4 years. If you purchase a particular security, or that mean is particular security, that mean is asset. If you purchase an asset, the today value of this security can be expressed using simple formula. You can see the security is asset, today value of the asset. The value of 100, 150, 180, 210 rather than or greater than 100 divided by the times effect, time value of money. That means time value of money. What does it mean about the R? R here? R is interest or return. Expected return. We can say that is return that we expected. So the value C capital in first year, and then capital in second, capital in third, and capital in fourth year, divided by 1 plus return, expected return in first year, and then the expected return in second, and then the expected return in fourth, third and fourth. Payoff and rate of return. So the R is return expected, or the rate of return. In another way, it can say this is the interest in bank. Payoff and rate of return. For a given investment, the dollar payoff of that investment is simply the amount of cash it returned to the investor in one period. So the return that investor get from the investment, the investor, and then allocate their money to investment, and then they will get the return. That is the rate of return. The rate of return of the investment is the future payoff. Net of the initial investment of the net payoff, expressed as a percentage of the initial cash outlay. It is the net payoff per dollar invested for a given period of time. We have an example here. An investment project that costs $10 to establish today will provide a cash payment $12 in 1 year as time 1 payoff is $12. Time 1 payoff, we can see the variable is C1. Time 1 net payoff is 12 minus 10. What is 10? The capital 10. So the net payoff is $2. Time 1 net payoff C1 in C0, or the $2. Rate of return is 2 divided by 10. 2, that is divided by 10. The initial. So you can say initial investment, future payoff net, and then the initial investment. That is the future payoff. And then the 10 is initial investment. This is the initial investment. We can turn this formula around to answer the question: how much money will I receive in the future? How much money will I receive in the future if the rate of return is 20%? The rate of return is 20%. How much money will I receive in the future? And I invest $100 a day. We can see that the answer of the course is 100 plus 20% of 100. That is the main capital, and this is the return. 100 plus 100 times 20%. 100 plus 100 times 20%. That is the return that you get in the future. So we will get $110 20. This is referred to the future value of 100 if the relevant rate of return is 20%. We can use this idea to compute all sorts of future payoff. For example, investment required 212 today and earning a holding period return or total return of 60% from now until to 12 times 12 would provide a payoff. The return is 60% and the money today is 212, and we can calculate the future money. The future money is the money today times pay or plus to the return from time. And we got the formula is this: C0 1 plus return of the 12 years or 12 period. C12 is the 12 period. The 12 is period of investment. The period of investment. The 12, that means is the period of the investment. Okay, I gave you the task to calculate the project. This is the problem, or this example cases. This is an example case. A project offer a payoff $1,050 for an investment of $1,000. What is the rate of return? The rate of return is 150 minus the 1050 minus 1000 divided by 1000, the initial investment. So the return is 50 per 1000, or and then calculate to 100%, and the rate of return is 5%. A project has a rate of return 30%. When a project has a rate of return is 30%, what is the payoff if the initial investment is 250? What is the payoff? In here, we have the rate of return is 30%. Rate of return is 30%. And the initial investment, if the initial investment is 250. The initial investment is $250. 250. And then what is the payoff? The payoff can see the payoff is C1 period. C1 is C0 times by 1 plus 30% or 1 plus R 1 period. You can see is 250 times 1 plus 30% or 1.3 times 250. Okay. A project has a rate of return 30%. What is the initial investment? That is the initial investment. If the final payoff is 250, this is called the present value of the future 250. You can see that we have the return is 30% and we have the C1 is 250. The question is the C0. What is the initial investment? The question is the initial investment or C0. How we calculate the C0? From this formula, we can calculate the C0 equal to C1 divided by 1 plus R1. Or we can see 250 per 1 plus 30% or 250 per 1.3, lower than 250. Okay, the initial investment. Okay, that is the problem in valuation of the investment. When we know the payoff, in one case we know the payoff, we know the investment, initial investment, and we want to know the rate of return. And in the second case, we know the rate of return and we know the initial investment, and we want to know the payoff. And in the third case, we know the rate of return 30 and the final payoff 250, and we want to know the initial investment. Okay, that is the problem in investment valuation. How about the compounding rates of return? What is the 2-year holding period rate? For example, here, what is the 2-year holding period rate of return? What is the rate of return for 2 years holding period? 2 years in compound, 2 years. If you earn 1 year rate of return is 20% in both years, in every years. Mark this, that 20% every year for 2 years is not 40%. Not 40%. Okay? It's not 40%. Per years you get 20% for every years, but this is not mean that 40% for 2 years. Why? Why isn't it? If you invest 100 at 20% for first year or one year, you got you get 120. You get 120 at the end of the first year. If you then reinvest the 120, if you then invest the $120 for the second year, you got 20%, and you got 144. Where does it come from? 120 times by 1 plus 20% for the second years. This is for first years. This is for the second years. This is the initial investment, and this is the second initial investment in the second year. The initial investment, the second year, come from the end investment of first year. So in the 2 years, you got the rate of return is 44%, not 40%. 44%, not 40%. 2 years rate of return. Okay? The R 0.2 is 44%, not 40%. That means is the compounding of rate of return. Compounding rates of the return. Okay? This 2 years rate of the return is 44%, is more than 40% because you earn an addition $4 in interest the second year as compared to the first year. During the second year, you earn interest $20 of interest earned during the first year, because the $20 that is your earn from the first year, and the $20 that comes from the earn of the first year will give you $4. The 20% of the 20 is $4. Okay? That means you have 100 in the first year, and this is the second, and you got 20% here, the 20% here, and the 20% here, so you got 120. And then for the 20% the second year, you got 100. This is 120, and you got 120 for this, and you got 4. So the summation is 120 plus 20 plus 4. 144 dollars. That means that you got the interest on $20, so you got the addition earned, that is the $4. We can represent this more generally using the compounding or the 1 plus formula. So we got this 1 plus 20% times by 1 plus 20%. So we got the 1.44. Its mean is 1 plus return on the second year equal to 1 plus return in 1 year times by 1 plus return in second year. It can be expected that in this formula, it can show you the formula is 1 plus return powered by n, that is the time or period, that is the rate of return. So C0 is 100 and the C second is C0 1 plus, when the return is 20%, 20% power by second years. That means is the second years or second period. This is the initial investment, that is the second period. The final money that will you get. Okay, if for the first year the 1 year interest rate is 20, for the second year the first year is 20, and then for the second year is 30. What the 2 years total interest rate? 2 years total? How many? The 2 years total interest rate, how many? If the per year's interest rate for all years is 5%, what is the 2 years interest rate? Per years is 5%, the 2 years interest rate. If the per year's interest rate is 5%, what is this 100 years interest rate? Okay, this task for you to calculate this question, to answer this question. Okay, please submit your answer in the task form. Okay, this is task for you. Calculate the 2 years total interest rate when the first year is 20% and the second year is 30%. And what is the 2 years interest rate when every year is 5%? And the 100 years interest rate when the every year's interest rate is 5%. Okay, submit. At least one, at least 1st January 2021. Okay. The term structure of interest rate. Today's average annualized interest rate that investment pay as a function of their maturity. The important message here is that investment of different maturity have different rate of return. This is true of even the treasury securities. And the following graph chart provides a view of the yield curve. It's talking about the yield or the final return that we get. The maturity is the popularity of the asset. popularity of the asset. You can see this, the yield curve and the maturity of the asset. Maturity of the asset and the yield. Okay. We can conclude our lecture today, the valuation investment. Finance view our investment as if there were a series of cash payment received at the different times. A series of the cash payment received at different times. That is our investment. The actual cost or benefit may not be in cash. However, the actual cost or benefit may not be in cash. However, for a proper evaluation of the investment, the cost and the benefit must be assigned to monetary value. Okay? To assign to the monetary value. So we can use time value of money. Okay? When every cost have to assign to a monetary value. So we can calculate time value of money. Once our incremental cash flow for an investment, at least finance can take over and evaluate the desirability of the project. So, incremental cash flow. The decision of whether to make investment will always entail a comparison of that investment to an alternative use of required cash. So, the decision based on the comparison that investment and alternative or another investment. How do we make such comparison? How make comparison? The return. Okay, the rate of return. The greater rate of return and risk, the return and the risk, we have to according this situation, the return and the risk. This parameter is very interesting for the decision in investment. And you will know about the net present value. The net present value, just as we can turn this around to determine the future value of the current cash flow, we can also use to determine the present value of the future cash flow. That is, the present value, the value money today, of the cash flow in future. That means the cash flow in future. This is the present value, and the C1 is the cash flow in one period future. And we can calculate the present value as the future cash flow divided by the rate of return. So that is the present value of the C1. That means is present value of cash in the 1 year tomorrow or 1 period tomorrow. That is another example. A project has annual rate of return is 30%. If we invest 100, we got 130. If a project has annual rate is 30% and payoff 130, what is the initial? Initial, we got that the initial is 100. 100 is the present value. 130 to be received in the 1 year if the reference rate of return 30%. So 100 is present value. 130 is the future cash that we get after the period is end. This is true because if you had 100 today, it would become 130 in 1 year investing at 30%. Alternatively, we charge next year 130 to the 30%. Rate of return we could receive if we had money, no. That is the net present value. This technique can be used to find the present value of cash at the future date. Okay? To find the present value, to evaluate the investment. For example, suppose the annual interest rate is 50%, annual interest rate is 50% for years 1 and 2, and you will receive 300 and you will 300 in 2 years. What is the present value of this cash flow? You can calculate this, the 300 times by divide by the present value of 300 in second period is equal to 300 divided by 1 plus 50% powered by 2 period, and you will got this 226.84. That is the present value of 300 in the 2 years next. We calculate the present value, the today value of this cash. Okay, this example. So what? How does this help us evaluate a project? Investment project have a lot of cash flow. Yes, the investment project have a lot of cash flow. At the different point in time, to make the investment decision, we need a way to compare cash flow. Received at different time. You have to compare cash flow that received in the different time. We cannot compare 100 today with 120 in the next year, but we can compare 100 today with the present value of 120 in the next year. So you can compare 100 today to the 120 in the next year. You can compare 100 today with the the present value of 120 of the next year. Okay, the present value of future cash flow are all in term. Okay, investment decisions are all made by comparison with a comparable alternative. It is better than an alternative use of the upfront investment. Okay, that's all for our lecture today, and thank you very much for attention. Meet you again in the next week.
Assalamualaikum warahmatullahi wabarakatuh.